International Tax Advisors with another episode of Tax Briefs. So previously we've discussed some domestic concepts, 2 layers of taxation and entity choice. Now we're going to start to turn to some of the international concepts, namely outbound versus inbound international taxation. So outbound, generally, because we're always thinking from a U.S.-centric standpoint, is U.S. investing into foreign. And inbound is the opposite, which is foreign investing into the U.S. Both of these topics are completely different within the tax code. The same international tax concepts do not apply. They tend to have their own regimes. Generally, people that are taxed on outbound taxation deal with concepts and terms such as controlled foreign corporations, that's CFCs, passive foreign investment companies, that's PFICs. You also hear of concepts like phantom income, picking up the income in the foreign entity before it's distributed. Those anti-deferral regimes, as they're also called, Subpart F, GILTI, global intangible low taxed income, and FDII, foreign derived intangible income. These are all concepts you will only hear in regards to outbound taxation. Inbound taxation has its own concepts of when we tax this foreign person and whether or not their activity rises to the level of a trade or business in the U.S. And we'll get to a slide or a tax brief later on how to determine whether someone's activity has risen to the level of a trade or business. But some of the terms you'll hear with inbound taxation are effectively connected income. That's ECI. You hear a lot about income sourcing, and that is determining where the income is made. And we also have concepts to worry or consider, which is how much time does this foreign person spend in the U.S., whether they're subject to, what type of tax regime they're subject to, and that is substantial presence. So those are just some of the concepts you hear about in inbound and some of the concepts you hear in outbound. We will keep them separate and hope you enjoy.